Hey guys, JC Parets here of allstarcharts.com and welcome to the show. Big shout out StockCharts TV for having me on. David Keller, what's up? So what we like to do here is three things. First of all, let's make sure there's a lesson. So let's say all my charts suck and I bring no value to the table. At least there's a lesson you could take out of this. So that's the first thing we want to do. Then we're going to dive into the charts. What are we looking at? What stands out? Where do we want to focus on? What do we want to ignore? What do we want to be buying? What do we want to be staying away from? What's going on in the market, obviously. So that we're going to dive into those. And then we're going to take some questions. You guys have awesome questions. I encourage you to keep firing them in. You guys are smart, right? So it's like having like an army of eyes all over the world. JC, take a look at this. What do you think of that? I love it. Please keep them coming, and we're going to answer them right here. So those are the three things. Now, what's the lesson of the day? For me, I think the lesson of the day is quite obvious that, at least to me anyway, that I think it would behoove investors to not categorize themselves as a type of investor. More recently, we have seen people that call themselves growth investors. JC, I invest in growth stocks. I like buying growth stocks. I have a portfolio of growth stocks. I'm a growth investor. I'm a Cathie Wood disciple. You hear all these things. Well, is it that you're a growth investor, or is it that you are too weak to overcome your recency bias? Which one is it? Are you calling yourself a growth investor because a lot of your growth stocks did well last year and in over the last half decade or so? Is that why you're a growth investor now? I would argue probably, right? I think it's recency bias, right? What about the SPAC investors? Have you noticed how all those speculicious characters that were celebrities, billionaire investor celebrities, billionaire launching of SPAC people? How'd that work out? Have you noticed how they've all disappeared? You're not getting any follow-ups from these people. No apologies, nothing. And to be clear, not that they need to apologize, not that they should care about you. There's no reason why they should. They're not in the business of caring about you as an investor. They're in the business of making money. And for them to make money, for them to dump a crappy SPAC on you, if you're willing to buy it, they're going to sell it to you, right? They don't need to follow up or hold your hand or apologize or anything. Don't be a bag holder. That's not what you want to be. We're seeing a lot of those bag holders. People really like being bag holders. And what is a bag holder? It is those that are left holding the bag. And I think that we shouldn't make fun of those people. I don't think that we should, troll them and stuff like that. They are very important because bag holders are the people that are buying the stocks that we as investors are dumping upon them, right? Growth stocks have been under distribution since last September, which we'll take a look at now in a minute. The bag holders are the people that still own that stuff. They're just sitting there holding the bag, right? And you don't want to be one of those people. To be clear, we need those people. We are thankful for those people that provided that liquidity to dump shares upon them. Thank you. We appreciate it. But remember, they're important people. But it doesn't mean that we want to be them, right? We don't want to be bag holders. We want to be selling to the bag holders or buying from the bag holders on the opposite end of the spectrum. As they're dumping out at the lows, we'll be there accumulating shares, right? So those people are very important. So that's the lesson. Don't pigeonhole yourself into a type of investor. If I'm going to pigeonhole myself into a type of investor, it's the type of investor that buys things that are going up and sells things that are going down. The only way to make sure that you own the strongest stocks is to buy the strongest stocks, right? So if you're bottom fishing these garbage growth stocks that are getting killed, yeah, maybe today's the bottom. Maybe. My bet is that it's not. My bet is that things are going to get worse, much worse. We haven't even seen funds blow up yet. And these guys are leveraged to the hilt. These margin calls are going to be coming in, which are just going to exacerbate those losses. I don't think we've seen anything yet. I think things are going to get a lot worse for growth investors, a lot. And I'm certainly hoping for it. We're betting very aggressively that things are about to get a lot worse for growth investors. So we're certainly big fans of Nasdaq sell-offs. At least we have been over the last couple of weeks anyway. All right, let's get into it, baby. Let's rock and roll. What are we seeing? What are we seeing? What do we got? What do we got? What we got is year two, classic year two behavior. Chop, 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 right? We talked about this before a couple of weeks ago. Chop, chop, chop. You know, we had the low in 1974, epic low, major rally throughout 75, historic year. What happened in 76? Chop, chop, chop. I was born in 1982. Stock market bottomed. Maybe it was a coincidence. Maybe it wasn't. We can argue that another day. But needless to say, the stock market did bottom in 82, ripped throughout 83. And then what happened in late 83, early 84? Chop, chop, chop. After the tech bubble burst, we had this major bottoming process. Ultimately, that low came in 2003. We had that initial thrust. And then what happened in 04? Chop, chop, chop. The 2009 low, I remember it well. A little too well. Still have post-traumatic stress disorder from it, I believe. I think a lot of investors do. But needless to say, major thrust off that 09 lows. And then what happened in 2010? Chop, chop, chop. Saw an interesting analog today from somebody. Her name is Katie Stockton. She's not like, you know, Mrs. Analog. In fact, she dislikes them as much as I do, I think. But she did, and she actually even used that caveat. She's like, I don't really like analogs, but, and her analog was this one, 2010. So if the 2009 low in 2010 was the equivalent of last year's March 2020 low, then we are right here, right at that peak, literally to the penny. So this is what to expect moving forward according to that analog. Regardless, we've been talking about it for some time. Chop, chop, chop is really, should be expected, especially after the best 52-week returns for stocks in over 75 years. Anything else would be abnormal. So in fact, a choppy environment is perfectly normal. Again, anything else would be abnormal. By the way, if you're interested in these charts, email info@allstarcharts.com and make sure to use the password because I give a lot of presentations around the world. You're going to end up with some Taiwan semiconductor presentation if you ask for the wrong one. So make sure you use the password info@allstarcharts.com. The password is growth problem because if you own too much growth, you have a problem. You've had a problem for some time. It's not anything new. We call those trends. So growth problem is the password. All right. So we've been talking about the large cap value versus growth, or in this case, growth is the numerator. So growth versus value. Just like the bigger the base, the higher in space. Louise Yamada, shout out Louise. She also taught me that the bigger the top, the harder the drop. And this is a massive top. And then notice how the bounce in large cap growth on a relative basis in March and April was much more muted when you go down the cap scale. Small cap growth versus value had almost no bounce and is leading the market lower. Growth stocks are making new 52-week lows relative to value as we speak. Technology making, look at these tops. And this is as of this weekend. These charts look way worse now. These are from the weekend. Technology relative to the market, major tops. Growth stocks relative to the market, major tops. Like these are charts that we sell, not charts that we buy. And the beauty is that the bag holders like to keep buying these dips. Keep buying them. You can have them. I'll keep taking the other side of that. Meanwhile, financials making 52-week relative highs, materials making new multi-year relative highs. These are the value areas of the world, my friends, the value areas. And then an interesting breadth thrust reading last week. These are the percentage of value stocks that are making new 63-day highs, highest reading in half a decade. And what do we know about breadth thrusts? Is that they tend historically to come near the beginning of new bull markets, not near the end of them. So if you think this rotation into value is over, this breadth thrust would argue that maybe we're just getting started. And then when you look at the new 52-week high list, we got a record. This is as of Monday. So we got an even, as of over the weekend. So on Monday, we got an even expansion in the New York Stock Exchange, which is in the light blue. A lot more value, a lot more international in the New York Stock Exchange. Meanwhile, in the Nasdaq, again, this is as of this weekend, no new 52-week highs, ghost town. Let's remember what's in the Nasdaq. You're not getting any financials. You're not getting any materials, no energy, no real estate, and you're getting like 2% industrials or something like that. So you're just not getting any value exposure at all in the Nasdaq, and it shows on the new 52-week high list. So the reason I bring all these things up is that the reason I'm bringing all this up is it's not one chart. It's not one indicator. We're looking at all these things. They're all telling us the same thing. Growth investors are getting crushed. And it don't look like that's changing anytime soon. And we are certainly hoping that it doesn't. We hope that these growth investors get hit even harder, as hard as possible. Keep losing money because we're short the Nasdaq. So let's get into that in a minute. Hopefully you tuned in last week where we're talking about being short the Nasdaq. And if you are short, kudos to you. If you are not, I encourage you to identify some of these trends. One thing that I think is really important, folks, is to understand that this underperformance, so growth versus value, if you want to just get right into it about what's driving these things, it's technology on the growth side and it's financials on the value side, right? These are two big drivers on either one of those. So it's less about the fact that growth has been getting destroyed relative to value and more about where it's happening. We just lost the dot-com bubble highs. We are now back below those levels. So what do we know from failed moves come very fast moves in the opposite direction? So again, this is further evidence that if you think that the rotation out of growth is over or almost over, this is evidence that it could just be getting started. And we are certainly hoping that that's the case because we're short. Look at technology making new 52-week lows relative to financials. When was the last time you saw that? And if you want to look at a beautiful base, I don't have it here with me, but look at European banks relative to U.S. tech. And look at that base over the last year. Woo! Boy, that's a beautiful base. So anyway, needless to say, we're still short the Nasdaq, obviously. We're thrilled about it. The trade is 338. Those are the February highs. If we're below the February highs, you stay aggressively short the Nasdaq, right? That's been the trade. That's still the trade. The trade's working. And all of the evidence coming in, all the data coming in continues to suggest that that's the side we want to be on. Notice above, this is the Nasdaq 100 relative to the New York Stock Exchange Composite, which we mentioned has a much higher. By the way, this chart is from last week. We're way down here now, just to be clear. But this was really the entry. And then this is an updated chart on Apple. Notice how Apple couldn't get above 138. Look at Apple relative strength putting in these nasty divergences. Momentum putting in these nasty divergences. I think Apple's got a long way down to go. I still like Apple short as well. Again, only if we're below those former highs from September. These are the September highs. So if we're below the September highs, 138, we stay short Apple. Maybe it drops below 100. I don't see why not. I think that would be a nice, just the fact that Cathie Wood, who's like the poster child for like growth investing, which by the way, anytime somebody becomes the poster child of anything, it's probably a good fade. From what I've learned in my experience. The fact that Cathie Wood uses Apple as a cash equivalent instead of going to cash, whew, things could get ugly real quick. If you think this is ugly, you ain't seen nothing yet. By the way, if you're interested in these slides, again, info@allstarcharts.com. Make sure to use the password growth problem. Growth problem is the password. So what is the bond market saying? Is the bond market agreeing with our short stock thesis? The answer is yes. New highs in the S&P 500, and look at high yield bonds underperforming treasuries. Classic. Haven't seen that since late January of last year, which is part of the reason we were so bearish of equities going into February of 2020. Boy, did that work out well. Needless to say, the bond market is giving us the same indication. I don't think that there's enough evidence to suggest that we're going to get a market crash. I guess it depends what kind of market you're looking at. The S&P 500, not so much. Maybe the Nasdaq, maybe some of these growth ETFs. Yeah, you could see a crash. I'd be surprised if we didn't. And the bond market is confirming that. If you look at some of the other credit spreads, look at France blowing out relative to, look at France, German spreads blowing out. I think that's interesting. Haven't seen that in a while either. Very interesting. So we're seeing credit spreads widening. That is indicative of a messy market at best. A downward market under pressure in terms of the stock market at worst. And I think it's the latter. I think lower prices for stocks continue. Meanwhile, speaking of things that are much different than they were last year, gold's making new highs, consumer staples on a relative basis, pounding out that double bottom. These are things we haven't seen in a while. And these are the types of things that we tend to see when stocks are under pressure. Guess what? Stocks are under pressure. And I think that trend continues, most definitely. So 1,800 on the gold. If we're above 1,800, I think we stay long gold. Or I know we want to stay long gold. I shouldn't say we think. I believe that is the best way to continue is to stay long gold if we're above 1,800. How high can we go? I don't know. At the very least, back to the former highs, 2,200, 2,300 or so. But realistically, we break out of there at 3,000. Why not? Why not? The gold miners trade keeps working also. It is down today. Is it down today? It is down today. Last I checked. Yeah, it's about down 1.5% or so, down to 37. So we're 6 points in the money still. I think it gets back to the mid 40s. I like gold miners. I like this breakout, right? Former resistance, broke out last year, retested, turned in support, off to the races, hit our upside objectives, like to the penny, right? Sold off, that former resistance turned into support. We call that polarity. And we're breaking out of this downtrend line, right? Can't ask for anything cleaner than that. So I like gold. I like gold miners for the first time in a while. It's been working. So we're going to stick with that. One more thing I wanted to mention is look at the chart of Newmont Mining, NEM. 72 is the level there, folks. We're talking about a base that goes back to the 90s. So if Newmont Mining breaks out and you start to see this thing above 72, how high can Newmont go? 150, 200? Why not? 25-year base? Why can't you see 150 or 200? I'd be surprised if we didn't. And what's even more important is think about what the environment is going to look like, what the world's going to look like if Newmont Mining is rallying 100, 200%. What does that world look like? Right? Something to think about. Because those are the implications here. And we're in favor of it, right? We're in. It's a good bet. Meanwhile, financials just put in a breath thrust last week as well. Look at the percentage of new 52-week highs. Highest we've seen over a decade. What do we know about breath thrusts? We know that they are things we tend to see early in the cycles, not late. So we want to be buying. If they start hitting financials aggressively, we want to be buyers of that pullback before we're buyers of tech pulling back, right? I was taught to buy smiley faces and sell the frowny faces. That's how I learned it, folks. JC, you want to buy the smiley faces, sell the frowny faces. What do we see here? Bitcoin versus Ethereum getting slaughtered. Slaughtered. Tech versus financials, slaughtered. Right? Buy the smiley faces, sell the frowny faces. This chart, I'd be remiss if I did not show you Bitcoin's market cap dominance. And we're not just using that to be dramatic. That's actually what the chart is called. Bitcoin's market cap dominance. When you look it up on TradingView, that's the chart. It's dominance. So aggressive, maybe. Dramatic, for sure. But that's what it's called. What do you want from me? Anyway, look at the double top. Right? So this is Bitcoin as a percentage of crypto. Pushing 70%. In 2019, back there earlier this year, and then just completely fell apart. So Bitcoin was over 70% of the crypto market. Now it's down towards 40. I think that's bullish, right? It's like saying small caps are outperforming, Apple, or small caps outperforming gold. That's how it looks like to me. I don't think that's bearish at all. Big culprit there is Ethereum, as Ethereum's at about $500 billion in market cap. Look at that base, right? Look at that breakout. So I think we get back up here. I think we get all the way back up. And, I talk to smart folks, and they tell me that Ethereum and Bitcoin can get to 1-to-1. Why not? Why not, they tell me. And I don't have an answer as to why not. I think it can too. So 3,600, because that's what all this is about, right? JC thinks the Nasdaq's a short. JC thinks that this is a buy. I don't know what's going to happen, to be clear. I have no idea what's going to happen, right? If I did, I wouldn't be here. I'd be on a beach somewhere. I don't know. I don't know what's going to happen. So we live our lives based on if-then statements. And if Ethereum is above 3,600, we stay long. If it's not, all bets are off. How low can it go? I have no idea. I can go to 0. I don't know, right? If-then statements. If Ethereum is above 3,600, we want to stay long. If Ethereum is not above 3,600, we do not want to be long. It's that simple. Look at these bases. These are serious bases, folks. Serious bases. It doesn't necessarily mean that these are the breakouts. Doesn't necessarily mean that we need to dive in, even though I already own the Cardano, because we're above 147. And I want to make sure that I give you the correct. Let me just make sure I give you the correct prices, because these charts are zoomed out. Multiple axes can get very confusing. So I just want to make sure that we're clear. So Monero and Cardano, these are, you got a mid cap at 8 billion in the Monero, and then you got a large cap at 50 billion on the Cardano, right? 54 billion, something like that. So you're buying a large cap in Cardano, and you're buying a big mid cap that's about to graduate into large cap in Monero. These are big, these are serious market caps. These aren't like little things where, like, you know, you're messing around in your personal account, but, you know, no. These are real asset classes. These are real market caps, right? And we want to be buying these breakouts. So Monero, up here, the level's 470. 470. If we're not above 470, we cannot own Monero because we're still below overhead supply. We're currently right around 440. So 470 is the level. These are these former highs right here. And we want to be buyers on a breakout and only be long if we're above 470 with a target of 740. But to be clear, we are not above those levels, right? We're not at all. Another Cardano, the level is 147. We are currently above that. We're at 167 currently. 147 is the level there. That puts us above the former highs going back to February. So if we're below 147, this would be a failed breakout. The failed breakout, which started on May the 6th. Nasty failed breakout. And what do we know from failed moves? Come very fast moves in the opposite direction. So again, to be clear, we only want to be long Monero if it's above 470 with a target of 740. We only want to be long Cardano if it's above 147 with a target of 340. Again, if we're not above 147, you can't own Cardano. If we're not above 470, you can't own Monero. If we're not above 3,600, you can't own Ethereum, right? You can't own it. Too much risk. You can, I mean, you're happy. You can do whatever you want. I mean, I'm not going to tell you what to do. I'm not going to own it, to be clear, right? By the way, if you really want to geek out, I highly encourage you to listen to the podcast that just dropped yesterday with my good friend Paul Sienna, who is the chief strategist of fixed income, commodities, and currencies at Bank of America Merrill Lynch. He's director of research there. Long title, fancy position. But him and I, back in the day, we used to study for our CMTs together, like in 06. So we go way back. Always a fun conversation with Paulie. And because we're old friends, I just littered him with questions, just like firing him. And he would just chuckle and answer them. So he talks to, a lot of the smartest portfolio managers, some of the biggest portfolio managers in the world. So at the very least, we want to hear what he has to say. It was a really good podcast. I really, really enjoyed it. I think you will as well. So you can go to iTunes, go to the blog. If you can't find it, email me. I'm easy to find, and we'll get it to you. But easy to find. Just search iTunes. Just search All-Star Charts on iTunes or Spotify or anywhere you'll find it. Me and Paul Sienna. All right, let's get into the minor leaguers report. This dropped this week. To be clear, the minor leaguers these are small caps. We are scouting the farm system for the next mid caps, right? So these are between $1 and $2 billion in market capitalization. So as soon as they get above 1 billion, they enter the radar. As soon as they graduate, as soon as they move above 2 billion, then they graduate into mid-cap status, and then they enter other scans of ours. So these are specifically the minor leaguers. We're scouting the farm system for 30 to 100% gains. And again, 1 to 2 billion. And by the way, we open it up to all the industry groups. Our 2 to 100 club, for example, you see all of your oil and gas, specialty retail, gambling, banks. You see a lot of financials here, insurance. So some of our scans, like the 2 to 100 club, are very specific industry groups. And for the minor leaguers, we open it up to anybody, right? We don't care. If you're between 1 and 2 billion, that's the only thing we care about. And then we sort by proximity to new highs, looking for relative strength, et cetera, et cetera. All right, let's dive into these. Some of the, there's a lot of these names that are still under resistance, which is fine. They'll just stay on our radar. So this first one is Oxford Industries, OXM. This is a $1.6 billion apparel manufacturing company, OXM. And we only want to be long if it's above 97. Currently, it's not. Right now, because the 97 puts us above these former highs. Right? So if we're not above 97, you can't own it. Can't own it. We're still below overhead supply. We only want to buy this if this base has broken out. And it hasn't. And the market's under pressure. So we shouldn't expect it to anytime soon. If this was 6-7 months ago, I'd say get ready. It's about to break out. Or it already broke out. Let's go. But in this particular type of market environment, that's just not the case. So let's be patient. We only want to be long the OXM if it's above 97. We want to stay out if it's below. Enpro Industries, NPO. This is a $1.9 billion industrial technology conglomerate. It operates all over the world. And we only want to be long if the stock is above 95. And currently the stock is not above 95. And why do we only want to be long if we're above 95? Because that puts us above the 2018 highs. And that would complete this base. By being below those levels of 95, that is the market telling us that it has yet to complete the base. And do we want to be long stocks before they complete the base? The answer is no. Hell no. Why would we want to do that? Patience is a virtue, especially when stocks are under pressure. But keep these on the radar because these are beautiful, beautiful bases. All right, let's talk about Tenant, TNC. So TNC is a $1.5 billion floor cleaning equipment manufacturer. How about that? TNC. And we only want to be long if it's above 86. Like the others, it is not above 86. But we can only be long if it's above 86 because these are the former resistance levels going back several years. If it's below 86, you leave it alone. We only want to be long if it's above 86. Now, to reiterate, some of you might be thinking, JC, why are you giving us these stocks that haven't even broken out yet? Well, it's a function of the environment that we're in. Like I said, if I would have given this presentation 5-6 months ago, chances are we'd already be above that former resistance. Chances are we'd already be long the stock. But the market doesn't care what JC thinks. The market doesn't care about your feelings or your needs. The market's going to do what it wants. And it's up to us to identify what type of market environment we're in and what tends to happen in those environments. And stocks are under pressure. I mean, we're short. we hope pressure continues, right? Particularly in growth and Nasdaq. Now, with that being said, that's what we call relative strength. When the pressure lets up, eases up, right? That's when these stocks showing relative strength really start shining. So keep these on your radar. I got one more for you. This is Preferred Bank. PFBC. PFBC. Again, showing a ton of relative strength. $70 is my level there. $70. Can't own it unless it's above 70. Right now, it's chilling right around 66, 67. So it's right there. Keep these on your radar. I have a funny feeling that when the selling pressure in stocks lets up, which I don't know when it's going to be, but when it does, I think these are the ones that are going to be shining. So we only want to be long. PFBC is a $1 billion mortgage provider, FYI. We only want to be long if it is above $70. And if you're interested in these slides, again, info@allstarcharts.com, and make sure to use the password growth problem. Make sure to use the password growth problem. Info@allstarcharts.com, password growth problem. And we've got about 10 seconds here, so no time for questions, but I promise you we'll get to them next time. I actually did answer a few questions throughout the presentation, so I did get to a few. But info@allstarcharts.com, password growth problem. We'll send you the slides. I'm JC Parets of allstarcharts.com. Email me, find me on Twitter, StockTwits, Instagram, YouTube, Clubhouse, @allstarcharts. Come say what's up. Thanks, guys.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.